So you heard a little bit in the last panel about political risk, where we can't have a session in London without talking about the big one that we've been facing for the last couple of years, and that's Brexit. And what does Brexit actually mean? The Prime Minister, as we know, is famously fond of saying Brexit means Brexit. We've been scratching our heads about that. If her checkers plan is put into place, many people in her own party, people like Jacob Rees-Mogg and Boris Johnson, call it never-ending vassalage to the European Union. If we crash out with no deal, the Governor of the Bank of England says that means a run on the pound, a crash in housing and higher interest rates. So who to believe? What we do know is that we're in the final stages at the moment of the negotiations to complete what should be an orderly withdrawal from the Union next March. And if a deal is to be signed and ratified by the parliaments both in the United Kingdom and in Europe, it has to be hatched in the coming weeks. Some of the mood music just this morning, and the pound taking a bit of a bump this morning on some feeling that a deal may, or at least a draft deal, may be imminent. So, more than 2 years after the vote, we are finally into the home straight. So no better time to ask, what are investors going to make of it all? So joining me are three very distinguished speakers. We've got Michele Gesualdi, who's the Chief Investment Officer of Kairos Investment Management. He's responsible for the global multi-asset and alternative business. Kairos was founded in 1999, focused on total return and alternative strategies, and it has $14 billion in assets. Gina Miller is very well known as a businesswoman and campaigner for transparency, and most recently, of course, against Brexit. She was famously the person who sued the British government over their handling of the Article 50 process, forcing them via the Supreme Court to allow Parliament a vote in that process. And she also, of course, co-founded investment firm SCM Direct in 2009. And Barnabas Reynolds is the head of the Global Financial Institutions Advisory and Financial Regulatory Group at Shearman Sterling. He's advised various governments around the world on establishing new financial centres, for example, leading the team advising Abu Dhabi on its establishment on the centre in the UAE. And most recently, he's been at the forefront of discussions of how Brexit is going to affect financial businesses in the UK and globally. And he's advising numerous clients on the impact of Brexit on their business. So thank you to all of our panelists today. I'm going to start really, as this is the Bloomberg Invest Summit, what your advice for investors is. You know, we can debate the politics of it, of Brexit, speculate about the different outcomes, but what does it mean really for the flow of money? There is so much uncertainty out there about the outcome. So what are you telling your clients about how to navigate the coming weeks, Michele?
Well, thank you for inviting me to this panel. I mean, I think that we have reached a sort of nadir of pessimism and negativity around Brexit. If you look at the number of times that people talk about disaster, calamity, and so on, I think we are at a certain level of pessimism, which usually should warrant a sort of rally of UK assets and sterling. But in general, I think the approach should be to obviously try and navigate this uncertainty that is probably going to stay with us for a few months. It's uncertain when a deal is going to get done, if it's before the end of the year, after the end of the year. Our assumption is that something will get done, and it will not be a no-deal type of scenario. And this is clearly, I mean, if you look at sterling and rates and so on, there is a lot of Brexit premium in all of these assets. So the fair value of all these assets should be much higher. So sterling is probably 20% or 30% cheaper than it should be in a normal scenario. If you look at rates, even more so, because there is clearly the MPC seems to want to raise rates. And it's obviously looking for a deal in order to do that. They are under pressure to do that. And more importantly, there will be probably more issuance of debt in the next few years.
So you're seeing a bit of a, say we get a deal, you know, there's some rumours about this, some draft coming next week. Is that the moment we get this bump, or is it, we've got to wait for this deal to be ratified by the Parliament?
I think it starts, I mean, obviously the unwind of the shorts is the first leg, or usually in these sort of moves. That is starting to happen already, but I think it could be more pronounced. I mean, there is a lot of quantitative managers that are short sterling because that was the trend for the last few years. So you need them to cover their shorts, and then you get people to become a bit long.
There was a forecast out this morning. We've got a chart, I think, of sterling somewhere, but we have forecasts for possibly a 20 to 30% bump if we get out of this uncertainty, if we get a deal. So you would agree with that?
Yes, I would agree. I mean, it's particularly against the euro. I think obviously currencies are always a sort of beauty context, and if you look at the times now, I mean, it's not pretty to the eye because the euro has its own issues with Italy, the dollar has other issues. But if you look at sterling against euro, it's probably the most interesting way to play it because you can have the Italian situation be there for some time and maybe become even worse into next year, whilst the UK side may get resolved sooner than that. Yep. So you may benefit eventually from both of them, and the levels at which you are entering now are pretty extreme.
Yeah. Gina, you've been campaigning against this entire process and would like to see it presumably reversed, but do you expect
Can I correct you? And no, I haven't.
Okay.
It's extraordinary that that's always reported. I actually, if you read the reports, it said that after the vote, I said we were all Brexiteers now, but it depended how it was executed.
Right.
And that's the only thing I've really been interested in, is that could we do this in a way that limits the damage to not just us, but all our European neighbours? And that is actually the most important thing in all of this. But I think we've run out of time. And just to go back to the comments, this whole idea that you will have some certainty when the deal is done. No, we won't, because then we go into transition for just 22 months, possibly longer. But what happens at that stage? And just today in your own publication, you've mentioned that there is no certainty with WTO either, because you've got over a dozen countries who are saying, actually, we don't like the EU approach or the UK approach, so we're going to knock back on any proposals that put forward in any sort of renegotiated schedules. So uncertainty is definitely not off the table for the coming months, years, as far as we can see from a geopolitical point of view. And when you have regulatory, this idea that things are going to go back to sort of regulatory certainty, I think one thing we do know is that the idea that we'd have sort of bonfire regulations is not going to happen, that we are going to stay fairly fully aligned, which means that does give a level of certainty for the markets and for financial institutions. And my meetings in Europe and in the UK since the beginning of this process 2 years ago, I have been alarmed at what is reported in the UK and what's actually happening in the EU. Because just to give you two examples, the idea of enhanced equivalence, when everyone was talking about that, in the UK, it was this idea that it was a good thing for us, that somehow it was beneficial, that we were going to get enhanced equivalence. Whereas everyone I spoke to in Europe, every regulator, ESMA, everyone said, no, our idea of enhanced equivalence is you're going to stay fully aligned. So there was this completely different, sort of lost in translation as to what enhanced equivalence meant. And the idea that nobody's planning for no deal and it's going to be off the table, actually, if you look at the German equivalent of our DEXU department, the Federal Foreign Office, they consulted with ministers in July, and a bill was passed on the 5th of September, which means that they can now make transition laws that will bypass not just the UK, but other European countries to do this. So BaFin has signed up to this, Bundesbank has signed up to this. They are making plans for no deal, and they are not just doing it quietly. They're actually going ahead and making legislation. So has the European Commission. They've brought in 5-day emergency rules as well. And that this idea that it's off the table, I think it could be by accident, because we've run out of time.
If we get a bump next week, think that's a bit of complacency, and you wouldn't recommend clients to be that optimistic?
I'm told, no, just go back to the complacency. I keep being told that, the city's too big to fail and too big to conquer. That is an arrogancy, because, it won't happen overnight. It is a hugely important market, but it's on the move. The sands are shifting. Yep. And what do we say to clients? My investment team say what we always say. You cannot predict the future, so what are the things you can control? You can control your costs, you can try and dampen down your risk, and it's about diversification. So we have not moved our message to our client. It's about staying diligent, because nobody can predict the future.
There's a polling question, I think, for everyone here, which is related, which is about the future of the City of London, and we can explore that a bit. But the question is whether London maintains its position as the financial capital of Europe over the next few years, maybe the next decade or so. I mean, Barney, do you have a view on that?
Yeah, so when I'm talking to clients on this, I go through the three permutations for financial services, which is a very different discussion from the broader discussion on goods, the rest of the economy. For financial services, enhanced equivalence, which actually is something I came up with and has published a regulation that achieves that, and the template for enhanced equivalence last year, the white paper reflects that proposition, and there is devil in the detail as to exactly how equivalence works, but there is a lot of soft law on this already in EU law, but the dialogue needs to be very refined in order to be precise about what exactly you mean by equivalence. But I think it's highly likely that there will be such an arrangement in place. However, if there isn't, the default for financial services is not, in my view, nothing at all, albeit that even if there is nothing at all, there are various ways of trading in and out of the EU without this sort of architecture, as there are in other places in the world. But the actual default, in my view, is unilateral equivalence declarations by the EU. And we're already seeing shifts towards that from the pronouncements of Stephen Mayor of ESMA last week about a recognition of central counterparties here because of the importance of maintaining the efficiencies of netting against all other currencies and cross-margin.
So you expect that to be the case, that Europe will accept that there'll be this sort of unilateral acceptance of the city's regulations and that things can largely continue?
Well, that's not quite how I'd phrase it, but I think the EU would need, in the way that the whole of EMIR for derivatives clearing and the capital requirements were delayed in order to recognise US CCPs, which are less integrated with the European markets. I think there will be unilateral declaration of equivalence across most areas. That doesn't mean that they're agreeing to anything. I mean, obviously that's a unilateral step, and then the dynamics have to unfold from there, which is the UK then needs to maintain competitiveness because basically the reason for them doing that is liquidity and pricing here. So if that's maintained, that position is continuable.
Right, I mean, the poll is pretty clear here. We've got a sizable majority saying that London keeps its position. Do you agree with that, Michele, as a London-based investor?
I think I would agree in the sense that it's difficult, obviously, to make predictions for 10 years, but I think I would agree simply because the starting point is so extreme now. So if you look at the hedge fund industry, for example, 85% of it is, of the European industry at least, it's based here in the UK. So there will be people moving, there will be people relocating and so on, but to get from 85 to below 50%, I think it will take a very big shift. And that's just one part, but I think that's true probably for the whole of the asset management business. And secondly, I would say that it's difficult to make that prediction because in my view there is a bigger threat in a way to the City of London, which is not Brexit, but the effect of Brexit, which is probably, or the fact that Brexit is part of populism in a way and of a shift towards more populistic type of rhetoric and policies, and potentially even to the extreme of a Corbyn government. So I think that scares investors and markets much more than Brexit itself, at least from the standpoint of financial services.
You're nodding there, Gina. Is Corbyn the big worry rather than...
I think for the people who work in the city and the city itself, I think it is a bigger threat than Brexit, because I think the commentators who are saying we go into this sort of never-endum, where we're just in perpetual and sort of I'm afraid I think that may be an outcome because of the lack of arithmetic in Parliament to get anything through. So I think right now I would say that is a bigger risk than Brexit actually having a huge dent over the short to medium term.
Right.
Because the other thing you have to remember from a regulatory point of view is that globally the world is going is looking towards a single rule book. It's actually this whole idea that we can go in a different direction and diverge. Converging regulations is actually something that culturally and globally is happening. But Corbyn, I do think, is a threat.
Two points on that. I agree that there's been an awful lot of harmonisation, particularly after the 2007-8 crisis, of regulation in terms of outcomes and systemic risk, ways of addressing systemic risk around the world. I would say, though, there are different ways of achieving that. And the traditional UK way of achieving it, which protected us from the effects of the Wall Street crash, which is tried and tested, which is judgment-based regulation, high-level, high-quality supervision, higher standards, fewer rules, is preferable for the global markets, to my mind, than the prescriptive methods in the EU with the civil law purposive method of interpretation. And I think Brexit brings an opportunity to get that right. And the reason that we're where we are with the EU is because there isn't a federal regulator, so that the regulations are made almost as instruction manuals for the regulators, which brings with it systemic risk by diverting attention onto the minutiae away from the big points and the judgment-based supervision. Just one other point, though, to flag on a legal the legal side about the Eurozone. The other thing, and I was peripherally involved in the David Cameron deal, the other thing that's relevant here, which was a discussion we'd be having anyway if we voted to stay in, is the relationship between the Eurozone as it's emerging and the global financial markets. And the issue from the legal perspective is it's not a fully formed currency. There is no single sovereign backing it. It's a percentage committee-based interests. If one committee member falls out, the whole thing falls because the others have made clear they won't take on that debt. And so you've got quite a fragile setup. And at the moment, the regulatory architecture in the EU, and this was the tension that David Cameron sought to deal with in his deal, but it was inchoate, it wasn't complete, it was a sort of continual discussion that we would have still had in one version or another, and I think it's going to be a relevant discussion for Brexit, is that under the architecture, sovereign bonds are required to be treated in the Eurozone across the EU as a whole as zero risk weighted, and that they're required to be accepted by CCP, central counterparties, as collateral, whereas actually they're not sovereign bonds in the true sense of the Basel sovereign rules, because the reason for those rules and how they work is that a sovereign never goes bust, and so they're akin to cash, because you can always print more money to repay your debts. Whereas Eurozone countries are borrowing in a foreign currency. They can't print more money because they don't control the ECB to repay their debts. And therefore, the architecture, regulatory, and there are all sorts of other rules as well, but the architecture around the Eurozone at the moment, it does not marry up to the truth, which displaces and offloads risk into the global financial markets, and that's the real reason for the fight over euro clearing, because they want to massage the collateral.
You raised the question, I think, Michele, you mentioned Italy. I mean, I think it's interesting, isn't it, that the flip side to the Brexit question is with a Europe without the UK, and it's interesting that we're at this crunch point in terms of the deal negotiations while the Italy budget fight is happening. And I guess it raises the question what your view, the relative merits of whether the Eurozone, and maybe that would be expressed through the pound sterling rate, but would you want to be relocating somewhere else in the Eurozone considering the possible instability there? I mean, Brexit is one problem, but Italy for the Eurozone is a far bigger one, isn't it?
Yes, and I think also, even if you take Italy away, and as an Italian, obviously, I'm always willing to do that. But and frankly, the reality is that everyone focuses on the effects of Brexit on the UK and how damaging this will be to the UK. It's already caused probably a 2% shift in GDP. But the reality is that I think Europe without the UK or without the influence of the UK, particularly for financial services, but in general, not having an Anglo-Saxon influence is going to be very negative for Europe as a whole, because that was always a balance, that was balancing what the sort of socialist view of the rest of Europe was, and therefore this created, at least in some areas, a good equilibrium, and this will be taken away. So I think Europe without the UK is obviously weaker, but no one really focuses on that. On your question regarding sort of relocations, I think rather than Brexit in itself, which for asset management firms in particular, it's not going to change massively the landscape. I mean, there are ways around it, and there's ways to manage it. It's a very flexible business, I mean, asset management and financial services in general. But I think the real issue is to see what the approach of the FCA and the HMRC will be. In other words, I think everyone that I talk to does not mention Brexit as the biggest issue, but it's more about how regulation will be handled and how this will become a low tax regime or high tax regime, no one really knows. But I think these are the two elements that will affect business decisions as opposed to the framework in which you operate, the delegation, the equivalence. This can be handled, but the other two, and regulation in particular, is a much bigger focus for people.
I think we'll explore that, but I think we've got another poll question we could ask, which is about sterling, actually. I think it's about where we see the currency going. We talked earlier about there being this big bump, possibly, if we get a deal. But what is as an expression of, the faith in the economy of Britain versus the Eurozone or the rest of the world? And it'd be interesting to see where people see that heading, and if they agree with you, Michele, that sterling is seriously undervalued.
The issue is obviously against which other currency?
Yeah, well, that's true as well, okay. Maybe we should have probably clarified that. But look, there's a pretty strong view that it is stronger in the coming years as well. Just coming back to your point there about global regulation, and Gina, you made the point that there is this sort of impetus towards global unification. So the idea that we can somehow break free in Britain, and particularly in the city, is a sort of fantasy. Could you expand on that a bit? I mean, surely we're seeing some possibilities that we could change things, for instance, on banker bonuses where it gets raised? Surely we can attract more talent into the city if we free ourselves from this rule in the European Union about the amount of pay we can give. Are there any examples where we should see some divergence?
I think in time you may well see divergence, but that's not the issue in the next few years. I just can't see that we're going to get to a deal that doesn't have a transition, which means we're not fully aligned for some time, particularly because of the Irish border issue, but also because we haven't the infrastructure in place. This is sort of not what we can do in the future. It's what can we do step by step as we leave, because we are reversing infrastructure that we gave up to join the EU. So we don't have the talent in place to replicate some of the roles that we'll need. We don't necessarily have the time. And I do think there's a cultural issue facing the city. And actually, we've got 1 million people, a significant number from the EU. And there is a cultural issue to this, because if Brexit goes ahead, and I hear this an awful lot, and I know businesses are already saying this, that their staff are worried if they're from the EU. They're worried about whether they should be here, about whether they should bring up their families here, what will the culture of the UK be like. So there is an issue for talent as well. But from a regulatory point of view, I just don't see how it will change overnight. This whole idea of, the phrase that's used, bonfire regulation, it may well do in time, but at this moment, we are taking on ACRIS all the laws, and the challenging legal, I think, from a point of view of the law, is actually how do we get through the next bit of the acts that need to go so we leave, and what order does that take? Because the order in which we exit actually has an impact on the next lots of laws that come. So if, for example, there's a withdrawal bill before the meaningful vote, then that has certain ramifications. None of this is certain. We've got a long way to go, step by step by step, to get to even between now and December. So to even be thinking about what happens to regulation after 22 months, I think there's just too much to talk about now, and nothing will change in that time.
Barnabas, do you agree? You used a phrase earlier, I think, about sort of fewer regulations but higher standards. Is that where we should be heading?
Yeah, and I broadly agree with Gina. I mean, I think this will be an iterative process, but the direction of travel of UK regulation, I think, will be to simplify rule books whilst not diluting standards. In fact, we've been accused of gold plating EU standards because the standards that we agree with everyone else who are really running domestic markets don't tend to work for the global market. So we have to focus additionally on certain things that aren't dealt with in the rule books. And there's a massive distraction and cost embedded in checking all the compliance, checking all the detail of the 1.7 million provisions of MiFID II and so on, which no individual can carry in their heads. And I think so I think the UK will simplify that, and I think that's perfectly permissible within any architecture with the EU. So the way I see it is that it's really a dichotomy between the most likely outcome, which is some sort of version of continued collaboration with the EU on iterative discussions on rulemaking and allowing, under the architecture, more tailoring to the global markets, which I think would be good for everyone. Or something more sort of cold turkey, as it were, where then if the UK is forced to do something more dramatic in order to counterbalance the effects, I think that's very unlikely. But if it were to happen, the UK could do more quickly. The good thing is, actually, in the financial services sector, we do have the expertise in the UK to do this. There's super regulators and massive depth across the panoply. So I'm not concerned about our wherewithal to deal with the financial services regulatory architecture.
Does it matter who is the rule taker or the rule maker, perhaps, or does it just matter that there are the rules that everyone plays by?
That's a simplification. I don't see it like that. I mean, you'd be a rule taker if you agreed to something where rules are made by the 27 and applied here, and that's off the table. The Bank of England's made clear that can't be accepted, and rightly so. There's therefore a dialogue. I mean, economically, dynamically, does that mean the EU has to follow the global market here, which 80% is nothing to do with the EU, and the liquidity is here, and that's really the thing that the UK, by the way, needs to focus on maintaining. Or does the UK get tugged towards the EU on certain points? I think it'll vary by topic. I mean, bonus cap that you raised is a very sensitive one. We've traditionally
It'd be a fairly quick fix, that, right? They could just change that, right?
You could very quickly do that, and we believe that we deal with the point through the deferral, and that is something I think that could be tested technically, and it should be possible to reach a resolution on that, but that is seen as something where we'd be then changing our rules for reasons of competitiveness. So that's a sensitive one.
But obviously, you also need, the political will to do it, and it doesn't seem to be there, because if you look, obviously, in the Labour, we know what they are thinking. But the Tories have been shifting their rhetoric to the left for politically good reasons. But that's, a worrying sign, frankly, because if you look at what they are proposing on property, and with foreigners buying and being taxed more, and it's generally there is sort of behavior which is not exactly business.
He's sending out some chilling signals, do you think, to global investors? I want to come on to this kind of global view actually as well. You must talk to clients from around the world. I'm interested, we sit in the bit of a bubble here, arguing amongst ourselves about Brexit. But when you talk to people, I think we've got a chart of the Britain's trading partners and the flows of trade around the world, which is the Bloomberg function. When you're sitting, if you're an investor sitting in the US, if you're an investor sitting in China, what does this whole look like? And what do you hear from your global clients?
Well, I think it's very relevant, because the UK is running a current account deficit, which is pretty wide, and has been even wider in the last few years. And that requires essentially the rest of the world to finance the UK. So you need a financial account or capital account which is positive. So you need to incentivize foreigners to actually invest their money. And if the government is not acting in that way, well, the markets will adjust. And guess what? I guess rates will be higher to incentivize people to fund this budget deficit, to fund the current account deficit, and so on. So you need, obviously, rates to, I think in general, given what is happening to rates in the rest of the world, one of the best things to do is to be, obviously, being short rates, if you want, because rates will tend to go higher given this approach. And the UK needs global investors to finance them.
What do you think, Gina? What does the world think of us?
I think brand Britain has been damaged by this whole process. Not necessarily by Brexit itself, which was puzzling to many other countries, but it's actually the process, it's how it's been executed over the last 2 years. Globally, when I talk, there are lots of different levels on this, but from an investment point of view, there are more and more people saying we're sitting on our hands and we're just going to wait and see what happens, who's in government, what your deals are with the EU, if the WTO negotiations go ahead. There's a lot of waiting to see. But I think from a cultural point of view, the damage has been, we've always been seen as being the magnanimous, the pragmatic, the sensible, reasonable ones, and a lot of that is damaged. And then there's also the divide where we were seen as a very tolerant country, a very tolerant society, and that has also been dented, that view of brand Britain as being all the things that we were held up on a pedestal for. It's not gone, but I think there's definitely some damage that's been done.
I'm curious about, do you think we can ever decouple our image from the Brexit process, or do you think it's permanently tainted, and do you think there's a permanent impact on how the world perceives Britain as an investment destination?
I don't think it's as bad as that. Some damage has been done, but look at what's happening around the world. It's not just the UK. Look at the announcements that have come from the United States today on future contracts. You look at, this is just not a UK phenomena, and the revisiting of our cultures and our values is going on around most Western cultures, even as far as Brazil. I think we're in a moment of change in history. It happens about every 100 years or so, and we're living through that moment now, and we just need to decide what sort of a country we want to be and what we hold dear and how we trade and how we treat our neighbours. But there has been some denting from the travelling and the speaking I've done to most other people.
Right, we're going to have to wrap up a little bit, but I've got a final question for everyone, and there's a final poll question as well. As we head into these final few weeks in the negotiations, it's been the question on the Prime Minister's lips, but is no deal really better than a bad deal? That's for the audience. And then for my panelists, if you could all just take a few minutes to just do a little bit of crystal ball gazing, help everyone out in the room. What is the outcome in the next few weeks as people who have been following this process? Is it no deal? Is it something approaching the Chequers agreement? Is it a Canada plus, or something else, perhaps the sort of never-ending fudge that has been mentioned as well? Maybe, Michele, you could enlighten us.
Well, in my view, some sort of deal will get done, and I think it's going to be sufficient for markets to be relieved in that sense. I cannot really see a no-deal scenario, simply because Europe is fighting already two battles, Italy, Brexit, and a third one with the US on the all tariffs and so on. So it's very difficult for the EU to be very antagonistic in this phase. And at the same time, there is some consensus in Parliament for some sort of deal. So it doesn't really matter if it's exactly checkers or if something slightly different. I think the fact that there will be something done in a transition period which is slightly more clear than it is now, that would be sufficient for relief.
So an optimistic view. Gina, do you share that?
I'm absolutely shocked by that result. Knowing the people in this room and your knowledge and background, to think that 37% think that no deal is better. No deal means no transition, which means we leave on the 29th. On the 30th of March, you wake up in the morning. What do you think we've got in place to wake up to? I mean, I'm absolutely shocked by that result. So I don't think no deal should be even on the table. I think
there's a process in place to try to stop that happening, right? Parliament.
Well, this is all down to Parliament. This is all down to Parliament, because whatever comes back, there will be a deal. This is about damage limitation for the EU as well for us. I mean, everyone will try their best to get a deal. But then it's up to Parliament. And I don't think the arithmetic is there to get Mrs. May's deal, whatever she comes back with. So possibly it's not about deal or no deal. It's do we have an election or a vote?
Do we have an election? And what do we need? We need a new centrist party?
No. Not now.
So what is the outcome of that election? It's a toss-up?
Gosh, who knows? Labour coalition?
With the SNP?
Who knows?
Big question marks. Barney, can you wrap it up?
Yeah, so I don't think no deal is likely, as I've explained, for financial services. The no deal dialogue is about the goods element and the toggle between goods and sovereignty issues that is so contentious. But I think there will be a deal even on that. But that's the discussions. I don't think it really hits the financial services market in the same way. It would be a shame. I mean, I've published separately and produced a draft FTA chapter for the US for enhanced equivalence, and there are some warm noises coming back on that. But obviously, that's a give by the US to the UK. I think we could do a deal quickly on that, but we have a completely open market because of our overseas persons exclusion facing the entire world. So there's no sort of tit-for-tat concessions we would offer the US. It'd be great to have that deal and have access to the US consumer base and the corporate base from London for incubating products here. And if the arrangements are such that we are unable to negotiate that with the US, I think that would be a shame. But apart from that, I don't think this point is so relevant to the financial services regulatory architecture.
Great. Thank you so much to our panelists, to Barney, to Gina, and to Michele, and for your audience for your participation. Thanks a lot.